Global oil markets are flooded, and Canadian producers are feeling the squeeze more than ever. Prices for Canadian crude have slumped to their lowest levels since March, as Alberta's surging output collides with an already saturated global market. It's a perfect storm of oversupply that's once again testing the resilience of Canada's oil sector. According to brokerage data from Modern Commodities, the benchmark Heavy Western Canadian Select (WCS), traded in Alberta for January delivery, was priced at $12.95 below West Texas Intermediate (WTI) as of Wednesday. That gap widened after Tuesday's discount of $13 per barrel, marking the steepest decline since March. At that time, prices were jolted by a brief move from the Trump administration to impose a 10% tariff on Canadian oil imports, a policy that instantly rattled markets across both borders. What's driving this renewed weakness? Analysts point to a combination of ramped-up production in Alberta's oil sands and an international market awash in supply, from the Middle East to U.S. shale fields, leaving limited room for Canadian barrels. But here's where it gets controversial. Some industry voices argue that Canada's lack of sufficient pipeline capacity and ongoing regulatory bottlenecks are keeping the price gap wider than it should be. Others, however, see this as a global issue of simple economics: too much oil, not enough demand. And this raises a bigger question: is Canada's heavy crude falling victim to geopolitics, or just its own production success? As markets brace for the winter demand season, opinions are split. Some traders predict a short-term rebound if refinery margins improve, while skeptics warn that without stronger export routes or a pickup in global growth, the discount could persist for months. What do you think? Is this drop just another market cycle, or a sign of deeper structural problems in Canada's oil industry? Share your thoughts below. This debate is far from over.